Good afternoon. Welcome to Chicago, Future of Finance. I'm Oliver Rennick. We are live from Cboe as we are seeing some holiday cheer. Little Christmas gift for the bulls. Low VIX, sub 14. S&P 500 futures making all-time highs. That's what we needed in my book to call it a record. The index had peaked above for a moment, but we were still chopping around on the intraday charts. Well, no more. This is what you want. All-time records. What else is there to ask for? Market looking real firm. Not exactly exploding higher, but let's not get greedy here. That's not the holiday spirit. Look at the nice little candle here on ES Futures. 69.62 pops above the October to November high range. We've been battling for it. If you've been paying attention on the show, which boy, I sure hope you have been, because we've had a pretty clear message. And it's essentially been threefold. The first has been volatility subdued and likely to get cheaper. If you've got a hunch, bet a bunch, regardless of direction. That was point number one, echoed by Brent Kochuba, Noel Smith, our volatility experts, myself as well, humble host OJ, who point two has had the trade of the year, and it's giving us a gift continually into the Christmas season here. That's short master long stocks. What is going on in crypto land? You guys need to be seriously worried here. I'm not joking around. I like being right. It's definitely one of my favorite things, but I usually don't give myself too many back pats. On this one, I am. The fact that this is extending still, short master, while the S&P 500 is breaking out, I think this is major problems for crypto land. BTC also looking pretty soft here. Maybe the political support is waning. I don't want to venture too far into that realm. Might talk about that with Pete Najarian later on in the show today. That's been point two. Point three of this show has been to lean bullish generally, especially into the holiday season. Likely vol crush coming. Expiries not giving much of a window for bears to make a stand. They tried, they basically failed. It looked like there was a brief window of opportunity. The risk radar that I've had as yellow for stocks will have to turn green. I just got to plug it into ChatGPT, but it's been kind of a busy couple days for me. The yellow light on stocks will be flipping green. The red will stay on Bitcoin. For bonds and the dollar, don't really have much of an answer for you there yet. The macro situation generally has been pretty supportive, but it also hasn't really been that exciting. The dollar just kind of sitting down still in a range that I think is generally healthy for the macro. The 10-year yield, which was toying with 4.2%, is getting there again. Today, testing 4.2 before coming back down. If the bond market breaks this line to the upside in yield, meaning a breakdown in price, then I say you start shorting bonds again, and then maybe you have a different macro conversation to be had. But until this line here on 4.2 breaks to the upside, I don't think you've got too much to worry about right now. Mr. Noel Smith joins me from Convex Asset Management on the Zoom this afternoon. Noel, how you doing, sir?
Good. Got my Christmas sweater on. I'm no Grinch.
I like that. I saw that. It's looking real sharp. Because that's what I've been saying. We don't want to get greedy, right? That's a Grinch characteristic. But I think we also should be pretty happy to see where the market's at right now. It's not a blast off, but the VIX is certainly getting crushed.
No, it's been exactly what we kind of had talked about. You know, there's a handful of things to talk about. You know, we're looking at some metals, looking at, you know, MSTR versus MSTZ. We're looking at HYG, and we're also just looking at vol writ large.
The volatility, let's start there, because I do feel like that's kind of the basic thing, right? That's kind of first off, because if there's one way to summarize this market, it's been cheap volatility. The fact that it can get cheaper here, I mean, what are we at? Sub 14. High of the day, 14.5. This is like getting into like almost complacency territory, but for traders, it should mean the opposite, right? It should be implying that they should be putting bets on.
What kind of bets, I guess I would ask to that question? I can tell you what we've been doing. We've been looking at out-of-the-money call spreads and VIX options as basically a hedging mechanism. They're as cheap as they've been in memory. So if you want to look out to, you know, Jan, Feb, or March, those options right now are looking pretty good. Again, hedge when you can, not when you have to. And I think this is a superior time to hedge right now.
Okay. Anytime it's cheap to buy umbrellas and it's sunny out, by the way, mid 40s in Chicago here. So this city's kind of popping off. First we got the Bears win, and then we got sunny weather and December 23rd, no problem. I don't need a white Christmas. We already had a white December. So I know it's, you know, in Vegas, you guys have always, you know, it's always warm, but California up in the mountains a little bit different.
Well, I just moved from Lake Tahoe a few years ago, and we had, this doesn't even sound real, 67 feet of snow that winter. And it was just ridiculous how much it just dominates everything in your life. I just couldn't handle it. That's one of the reasons I moved to Vegas.
So, all right, buy umbrellas when they're cheap. It's cheap to buy umbrellas. Take me through how you put on that spread using volatility, using VIX as an instrument, as an asset class. Or do you use,
we
do you
put
use
on a
something
couple
else?
hedges. I can't be super specific, but looking at $5 or $10 wide call spreads with something like a 10-to-1 payoff ratio does make a lot of sense, and that can be done even better today. You can do that about 11.5 to 1. So if you're looking out to March, you're looking at relatively and absolute cheap vol. In addition to that, there's something to be said for credit being part of a AI fall apart narrative. So we've also looked at some HYG put spreads, and those are also quite cheap. HYG doesn't tend to move much, but it also doesn't cost much. But if everything does fall to pieces for whatever reason, you can spend not a lot of money there and get a lot of payoff if that does end up being necessary. So from a hedging standpoint, we're looking at HYG and VIX upside call spreads, and we're also long the market. Additionally, we're looking at the possibility of a margin requirement increase at the CME level for silver futures. If that does happen, silver puts could look pretty great. So that is also something else that we've had interest in.
Okay, one at a time. I love all those. I want to get to all of them. I'm glad you brought up silver to follow on from our conversation last week. Also gold breaking out. But just to come back real quick on the volatility hedge, 10-to-1 payoff?
Yeah, if you can pay 50 cents for a $5 wide call spread, there's your math. Pretty easy.
Okay.
And you can pay 42 cents for the one I have in mind. You can figure it out. Again, I can't give investment advice, but it's out there. It's for all to see. Okay.
We have the disclaimer here that investment commentary by the host is not financial advice. Pseudo host, you contributor, Noel, so I think you fall under that umbrella. But we appreciate. Okay, so tell me the HYG trade next to volatility as a potential hedge, because it seems like those arguably could fall into the same bucket of generally some type of hedge to an overall kind of happy, calm market, right? Because credit disruption would probably overlap with some kind of volatility move. Or is the spread that you're thinking about for volatility, does that only pay off if stocks go down, VIX goes up? How does it look compared to HYG shorts as essentially a bearish, pseudo-bearish kind of position?
Well, it is a bearish position, no doubt. So what I'm looking for is the most economic convexity that I can find. I don't really care where it is. Is it silver puts? Is it HYG puts? Is it VIX calls? All I care about is what do I spend versus what do I get if it works? And if you don't think it's going to work, then maybe don't put it on. But all of those that I mentioned already, the payoff ratio is very high. Now, a silver vol is quite high, and I don't necessarily expect silver to go down, but the idea that the CME increases their margin requirements and that does cause a pause in silver or maybe some kind of a pullback, to me, that's fully something that can happen.
Okay, tell me about the thought process for that then, okay? Understood on the VIX spread, understood on the HYG potential kind of disruptive fundamental, trade, and Danny Kirsch, I think, was thinking in the same kind of mindset as you on that point. We talked about that a little bit with him last week with Piper Sandler as well as being kind of a market hedge. But tell me about the silver thing. So what, because it's going to cost more to trade it, that might sort of dilute some of the appetite that's been pushing it higher in price?
Yeah, if you want to go out and buy a house and the down payment is normally 20%, so that's what you're putting into your model, and then all of a sudden the housing gods come down and say now it's 40% or 50%, you can all of a sudden buy a lot less house. So if the CME says that the margin requirement is increased by whatever percentage, and I'm speculating, I don't know if they're going to do this, but if that does happen, the idea that silver gets punished in some function of time, call it 30, 60, 90 days, it's completely reasonable. It's happened before many times.
I'm admittedly a little bit behind the news flow on this one. Where is that rumor coming from?
It's not. No, it's not a rumor. It's speculation on my end that, generally speaking, when you have a commodity at the CME that goes parabolic like this, that's on the table.
Okay, nice. Well, Shoot, we'll definitely watch, and big credit to you if something does happen in that realm. Right now, the market for it looks pretty unperturbed. The chart for SLV is pushing 65 now. I mean, it is ballistic to your point, though. Honestly, I didn't know that silver could move like this. I haven't really thought about it as that type of a high beta asset class. I guess anything's possible after what we saw for gold over the last few years, but this to me is just a bit shocking.
Yeah, if you look at gold, kind of in the same vein, obviously it's gone parabolic as well. You've got, gold at just under 4,500.
Right. But at least it took a breather for a couple months.
Yeah. But, for what I have on, I'm short some gold vol. I don't care about the direction of gold, but I have gold vol, and that's actually up a little bit today, so it's a small loser. But, something like a defined risk short vol strategy in gold, I have it on, so I think it makes sense. Would I tell you to put it on? I mean, that's up to your own individual risk appetite, but it's high. Can it go higher? Of course, everything can go higher, but it's something to look at, and I would flag that as opportunity.
Okay. Nice, like that. SLV, just impressive. Gold too, though. That one is held on my risk radar is green for a while. Gold's green, baby. It's been the most consistent one from my macro analysis. So I'm happy that those charts are working out. As far as the broader macro goes, I also feel like it's fairly conducive to all these things we're talking about right now, Noel, with the exception possibly if this 4.2% 10-year line breaks and yields start ripping. But if that's because the economic data continue to come in strong, then I don't see it as really a necessarily bearish event.
That's a larger macro conversation. Because if you think about what happens to rates, especially long-term rates that undergird the housing market, again, that goes into ultimately, I think, a currency decision, which is maybe beyond the scope of this conversation. But if you think about if rates go to 5-6%, what does that do to the housing market? And then if that happens, what happens to the economy? What does Trump do about that? And does Trump appoint somebody to the Fed that will bring rates down? I'd say probably. And then if that happens, what happens to the dollar? There's your trade.
Yeah, I'm with that. I follow the logic. That said, I'm also looking at this morning's numbers from GDP, and I don't know, it looks pretty good. I'm not really in the camp of the it's all fake narrative. I think the numbers are the numbers. We go with what we got. 4.3%. That's also a little bit of an extra dose of Christmas magic, possibly.
Admittedly, those numbers are stale. They are, trading in arrears, kind of a rear view mirror situation.
Right.
But irrespective
it
of
always
that,
is, but in this case, a deeper rear view mirror.
Right, exactly. But if you're looking at what, from what is now in the vol landscape, and which is usually the best predictor of what's going to happen, I mean, it's kind of like, why not have risk on? What are you waiting for? That's how I look at it. The only thing else I have on is some MSTZ, which is the inverse MSTR, which is the Bitcoin thing. And what I have on there is call spreads, because I think that if MSTR does fall to pieces, it'll fall to pieces at a nonlinear rate. Again, it's all about asymmetry or convexity. So the calls are just a bit too rich for me to own outright. So I've elected to go with call spreads, but I still think that's an interesting trade for people to look at.
Okay. Also, just as a good buy here and exit, because we got Pete Najarian, we got Brent Kochuba in the Zoom. The Zoom is lit today. I'm just going to end it on this note, Noel, because you also have a pretty good artistic and music taste. Nice little guitar player of your own. Fall to Pieces by Velvet Revolver. Great jam.
Great song. It's a great tune. Absolutely.
I don't think I can. If I play it though, this will get taken down. So unfortunately, I can't play it, but I can bring it up and point people in the direction. All right. So look, and if you do think it's going to fall to pieces, then short HYG, maybe buy those 10-to-1 volatility spreads. Great stuff across the board as always from Mr. Noel Smith, Convex Asset Management. Nice work there. I feel like we're kind of jamming, so I'll get to the break. I think we should bring in Pete Najarian, who's standing by, because it's not only Christmas season, it's Najarian season as well. Happy delayed B-Day to you, Mr. Pete.
I appreciate that. Thank you very much. Yes, it's been a really fun last couple of days, and then of course we got Christmas right around the corner, so it's all good.
Yeah, and we also got a little gift for you. Not just the market grinding up, but we got a massive Chicago Bears win that I think you put money on. Am I wrong?
No, and I was pretty excited about things. I just look at games the way I do, and I love what Caleb Williams has been doing in his second year, and the guy's only thrown 13 total turnovers, interceptions as the starting quarterback. So, the Bears have got a lot to be said, and the fact that they are sitting at the very top looking at everybody else, they still got a couple of games left, but I'll tell you what, I'm amazed at what the coach has done, what the players are doing, and what they've amassed from what it was just 2 years ago, 3 years ago when they couldn't win a game.
Amazing, right? I'm not afraid to admit that. I'll be the warm weather fan. I just like that there's good spirits in Chicago now because of it. Because Caleb Williams was also getting some hate kind of early on. People thought it was a false positive, but it turns out it's just downright positive.
Yeah. I mean, the guy is dominating. I mean, when you really look at it and you look at what that offense has done, the one weakness the Bears show right now is their defense. And so they've gotten a little bit better in the second half of the season. They've given up less points and less yards, but fortunately the offense is up there and doing everything right. I mean, the coach, everybody, you got to love what the Bears are doing.
Okay. To that point, we haven't run it in a little bit, so let's run it here while I pull up some of the Kalshi odds. Let's go to the gamble.
Love the gamble.
All right. Okay, so Pete, here's the thing: is the numbers for the actual odds for the Bears haven't really moved too much. I'm going to pull them up because they're at 6% right now on the odds for Super Bowl. What do we got to do, Pete? What do we got to do?
Well, you know what the problem is? You've got one division that's out there on the West Coast that has the Los Angeles Rams, who are absolutely outstanding, the 49ers, who Purdy is back and he looks fantastic, and Seattle with another quarterback who's had an unbelievable year. So when you look at that, you can understand why Chicago is where they are. That doesn't mean they can't go through the juggernaut of those various teams, but those are three of the best teams probably in the NFC right now.
Okay, so I guess is the nature, because I'm still kind of like warming up to all this. Obviously in Chicago, when you live here for a certain amount of time, you got to be plugged into what's going on in sports. But in terms of sports betting, it's very new to me, and it's not something I really participate in, to be honest, to be straightforward. More of a poker guy. But is it one of the things I'm thinking about is you've got such a limited, I mean, this is kind of the nature of sports betting too. You've got such a limited sample of events here to change these odds, right? How many games left until the Super Bowl? Not that many compared to how many days of trading, if you put on just a 1 month, expiry trade, right? You got 30 days. So these odds can move just enormously. And that's the beauty and the burden and the risk of obviously, participating in these markets. So I like to talk about it because, this is the speculative market, but, you could go from 6 to freaking 80, quick.
Absolutely you could. Well, let's be honest. I mean, you've still got a couple games yet left that they've got to play. How about injuries? That's always a possibility. So it depends on when you pick your spot where you want to go in terms of the betting side of things, of course. And every week is going to change, and that's going to shift things around based on injury, based upon health, and, of both different teams. So I think there's a lot of things that go into it, so it makes it a little bit more difficult. Quite honestly, I think the market sometimes is an easier thing to trade than some of those sports games.
Oh, I mean, yeah, it's all tough regardless, but I'm with you there. I mean, the volatility inherent in such a unpredictable, injuries, small number of events, the odds, can move pretty quick. But I feel like when you're generally kind of moving towards the realm of upsetting to the positive, and your spectrum of possibilities is 0 to 100, and you're at 6 right now, like I've been saying, look, I'd rather own the market at this point, right? I'd rather put it into a poker tournament, but still, I think by the standards of sports that, there's something to be said there for the Bears. Let's talk economics, Pete. That, I think, was the other big move here. Back to the GDP, okay? Because here's where I'll say, I know you guys have generally been thinking that Powell's kind of been slow to act, and let's get someone in there who's going to be a little bit more attentive. But I don't know, man. These numbers look to me like we don't need to be in a rush to cut. What say you?
I'd agree with you at this point because of the fact that we have had this last cut that we've gotten. So that was the problem I had, was a lot of folks were still saying, well, there's still that possibility, even though the fact that the CME tool told us there wasn't much of a possibility at all that they weren't going to cut. But I think by having this cut, now they can kind of sit back and relax a little bit and then keep an eye on things. And that's what their job is to be very timely with when they make some of these decisions. And right now, I think you could say, well, it's more of a 50-50 than it should be a 70-30. And I think you'd probably be right. But we still need to see so much more data. We're going to see more data. And that's one of the things that, of course, that we're always looking at is where are we now as compared to where we were 3 months ago, 6 months ago, and what does it look like into the future? I think sometimes it's crazy when people say, well, they're going to have 6 cuts this year. How can they possibly know that? If indeed they're actually going to be going off of the
numbers. They might as well be sports betting.
They might as well. And matter of fact, you know what? They might be doing some other kind of betting. But in any case, it makes it a pretty interesting proposal. But I do think that Powell actually did the right thing with the cut, along with the rest of the Fed. And going forward, it's going to be very interesting to see what the president influence might be and who's going to be the new chair.
Great, well said there. I think really good point on not being able to see, a year out. The Wall Street strategists who predict the S&P 500, some people argue that that's equally as futile, but it's actually not quite so much because we kind of just know the annual average is like 7.5%. And if you actually look at what the typical strategist kind of median is, their target, it's usually like 7.5%. So they're kind of just like playing the odds in a high probability way. But to try and figure out the Fed, how many cuts they're going to do, the broader economy, the political backdrop to it is fraught with error. So I think to your point, though, there's no reason to hike, right? There's no reason to hike. You look at things like consumer confidence and a few of the other prints that are a little bit more muted. Durable goods was not perfect, right? These are the types of things that still, when we're looking at backward-looking data, you kind of have to appreciate both sides. I just think generally it errs positively for the most part as far as the market conditions go.
Right. Absolutely. There's no doubt about that. I mean, I think that the second that you start looking ahead and you start seeing what those numbers look like from the CME tool, and then all of a sudden you actually get what you were expecting. Yeah. I mean, I think that there's a lot to that whole thing. And you know what? Generally, I think we've been able to navigate very difficult markets, especially this year, especially if you go back to April and you see all the devastation early on when things were going on with Trump and so forth and all the rest of it. But you know what? Sometimes you just got to push your way through. And I think what helped us a lot was earnings themselves absolutely just continued to go on this incredible ability to just beat and guide higher. We saw more of that, I think, this year than I've seen in a very long time. It's been absolutely incredible. And that has been saving the market time and time again, including Micron, who just came out and they saved the AI world. All they had to do is, they said, we crushed it. We can't keep up. It keeps on coming. And you know what? We're doing pretty well. Well, that's a stock that's done pretty well themselves this past year, as a matter of fact.
Beautiful move. Great eyes on that. Taking a breather after the earnings pop. Higher highs, higher lows. Just magnificent chart. Again, I'm in my business I've been running. I'm using AI. It's coming through for me again on a video that I'm making for somebody. It's just it keeps finding ways to get better, to improve. I know that scares people a little bit, but I'm kind of a guy that just, you got to ride the wave, man. You can't fight technology. You really can't. And I think the same goes for the market. You have moments where these kind of air pockets get popped, like we saw for Oracle. Okay, maybe that was too expensive. But I said, and Broadcom actually is more specific about that given the sell-off. But Broadcom never broke support. We got this chart up here at 320. And I was hammering on about NVIDIA at 170. Look at that line that held on NVIDIA. I mean, it's just beautiful. So all these things, I think, technically point bullish.
Yeah, they sure do. And then when you put all those things together, and even a Palantir, people sort of have forgotten about that name because so many other names have come out. Oh, they're only up 155% this year. It's interesting to see all of the naysayers that are out there that are punishing AI, and they've been talking about it for months, that it's a bubble, it's ready to burst, and all the rest of that. I still think that there's plenty of room in front of AI, and I think we're seeing more and more of that. And Micron was just a perfect example of exactly what we're talking about. They came through with the kind of numbers that actually, I think it just completely caught everybody off guard on how good their numbers really were.
Yeah, very good point. We need leaders. We need fresh, additional stories, on that front to kind of keep the narrative going. To your point on Palantir, another really good looking chart, still right below highs. So if you're looking for things that follow suit, anything in this category that you like as a trade right now, Pete? Anything that you've got money on right now, or you're seeing flows that are appealing?
Yeah, Micron's one of them for sure. I mean, it's up
Okay.
200%, yet I don't know that that's over. That I was the specialist on the Chicago Board Options Exchange for Micron Technology back in the day.
I didn't know that.
I got to tell you, it was a monster. It surpassed IBM and all the other big names that are out there. We had the volume, and it was absolutely incredible. I'll tell you a name that nobody ever puts them in with AI, but they should, is Caterpillar. Because people have looked past Caterpillar because the demand for generators, demand for power equipment, demand for all of these things that the AI world, the AI centers that are being built need, right? So it's actually an AI stock itself. So keep an eye on Caterpillar as well.
Yeah, that's a good point with Cat that is showing up maybe in the chart. Great year so far. At real kind of industrial use. This is why, people are still, for example, launching ETFs in this category. I was talking with someone this week who, in the middle of the fall this year, launched a suite of tech ETFs, and their idea is, look, all right, maybe we missed like the first, inning, if you will, or maybe we missed the first, phase. But finding how AI is going to move through different industries and manifest itself in useful ways really is, I think, the part of the cycle that we're in right now. And I do believe that. I'd actually also think, from what I'm seeing in financial markets, in the investment marketplace, not so much from like investing in the tech, but using it. A lot of people breaking ground in investment management, figuring out how to make the job easier for analysts, for portfolio managers, all kinds of stuff. So why not in the fields too for Cat?
Yeah, absolutely. Hey, by the way, I just wanted to tell you real quick because I know we're probably almost done.
Yeah.
Noel was talking about gold and silver. Let me tell you something. It started at the beginning of the year. It continued in the middle of the year. It continues even as of yesterday. We had 113,000 spread go on for gold, for GLD. Absolutely unbelievable, the kind of numbers that are coming in there. They were buying the 420s, selling the 435s. They were buying the 425s, another 113,000 to sell the 440s. So they're putting on giant spreads. This has been going on, Oliver, all year long. GLD just keeps on coming. And by the way, silver as well. SLV just continues to be something. Every single week there's something out there. So far, they've been going even further out into April. So they don't think it's over yet, even though this has been an incredible run by both gold and silver.
Yeah, you were on it. You talked SLV with us several times here over the last month. So nice eyes on that for sure. Pete, great stuff. Always fun. Man. Yeah, I love that shirt, by the way.
Well, I'm in Florida, man, so it's, this is Christmas in Florida.
I love it. All right. Good stuff. Sharks in the water, baby.
Thanks, Oliver.
Yes, sir. Have a good one. Thanks, Pete.
Thanks.
All right. 2-minute innovator buffer break. Then we're back. Spot Gamma's Brent Kochuba joins me next.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
There are two things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. Cboe is on a 5-year growth streak making billions, and its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader, and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance. Join me. Here having a good time as markets are looking pretty strong. We've got 25 minutes left in the session, and S&P 500 right now at 69.08 means about a 0.5% climb. If you've been paying attention to the show, my guy at the top 2 out of 3 days of the week has been telling us volatility has been cheap, and thus if you've got a hunch, to bet a bunch. Mr. Brent Kochuba of Spot Gamma here with us this afternoon. Always a pleasure to have you, Brent. And right now, I think pretty much everything we talked about, a lot of it at least, which was looking for the market to steadily grind higher. And if you had any doubt in that, to kind of use volatility, to your advantage. I feel like a lot of that has basically worked.
That's true, Oliver. And we took some heat in the comments section because we were talking about I've labeled this OpExmas because from OpEx through Christmas was this really bullish window, and it seems to be coming to fruition now. We're up about 2.5% from OpEx, so Thursday night to now. And the interesting thing was volatility was being serially underpriced, particularly at zero DTE stuff, where you could buy the zero DT straddle for like $35-40 and the market would move like 60 handles, and I would just keep paying out. It's a very strange thing. And interestingly, and kind of related to that, are two things. Number one is we got to talk about this guy, Captain Condor, today because it's a fascinating.
Yeah, tell me about that.
Huge size. Second one before, because it's a little bit quicker thing. No, VIX hit 1-year lows today, Oliver. I don't know if anyone mentioned that.
Exactly.
Yeah. We're in the 13s right now. Short-dated implied vols are in the 7s during this Christmas week, which is as low as you get, period, in the S&P. So tied to those cheap wings that we were talking about, thankfully Noel backed me up on those upside calls being cheap. He could have said the opposite and made me look kind of dumb, but he sort of agreed with me. So, just the fact that vols are just so cheap, but VIX getting smashed this week here. 1-year low is hard to believe. You have to go back to early December of last year to find.
It's really amazing.
So, we were talking about VVIX, how VVIX was a sign that no one wanted to buy calls. I don't know if the banks watch this episode here or watch this talk here, Oliver, but all of them are pounding the table on that thing. The loss of the VVIX basically just dying, which tells us that no one has bid for VIX calls is all that's basically saying. And so,
why is it the banks that are focused on that, Brent?
It's just a very indexified measure of what volatility is doing. So you can look at it and see, okay, nobody wants VIX calls. Now, last week we were talking about this because if you thought the market was about to implode, and price action wasn't all that great when we were at 6,800-ish, right? But no one wanted puts, right? No one wanted S&P puts. Nobody wanted VIX calls as something like the VVIX shows you. And that basically tells you that we're primed for a bounce because if the market's going down but no one wants to buy hedges, then we're unlikely probably to spill over. And the other idea with this is that the bears were fighting this window of OpEx and Christmas holiday, which contracts time, which is bullish for stocks because options decay picks up. So it's hard to be short over this window. Now, I know a lot of people, like Pete was just talking about, AI could be bullish, all that sort of thing. I think we open up to a window of weakness or time weakness after this week. But for right now, vol's as smashed as it could get, right? And we're kind of pushing the 6,900 all-time high area. If we close above 6,920, we're in that all-time high range. So, I still think we got another 0.5% to 1% possibly on tap here for this week. We'll see. that brings us to this other idea. So volatility is getting smashed. Related to this is this guy, Captain Condor.
Hey, Brent, real quick before you go there, to hammer home the point you just made, because one interpretation I've got is that we might get vol up, stocks up. Is that a scenario that could exist here over the next week? Because we've leaned bullish in the direction, but also in the view that vol's been cheap. So vol's gotten cheaper, which means to me maybe I should put on a trade that's long stocks, but also maybe long vol to some extent, because I've been looking for that juicy 2% day, and we have not gotten that yet.
Yeah, and if you look at single stock calls, they're starting to get bid, meaning call skew is starting to pick up in Apple and Mag 7 names and stuff like that. I think a big reason that the calls were so cheap in the S&P is due to the JP Morgan collar trade. There's a 7,000 lot, there's about 100,000 contracts at the 7,000 strike for 12/31 expiration. And that suppresses local volatility. So strikes in that area were extra cheap or suppressed by that big position. And so I think that vol was really cheap. So the idea that once that trade rolls off, that kind of upside strike vol starts to lift, I think is legitimate. And if you look at single stock calls, they're not super rich right now. So the idea that we could chase to the upside to start the new year, that's totally legitimate. I can't say why I wouldn't think that would happen. I for some reason, am thinking that maybe we have a little bit of a correction. But, the idea that we got stock a ball up, there's certainly room for that, I would say.
Okay,
we're not in
for
this
it.
situation where calls are getting so bid that you're going, hey, like we're over our skis now, it's time to
Right.
check. Like Core 1M, for example, if you look at that, the Cboe correlation index, nowhere near sort of like our risk level, which is around 8.
Okay. Definitely not having it right now. It seems like it's a scenario I could envision if people, are feeling flush, feeling like their wallets are in good shape after holidays, good GDP print, Fed gonna cut. Why not start, ripping some more upside now that we get through this chop period that we're in? So that's kind of the scenario that I'm considering. Now tell me about the Condor, man. This is because he was a Wall Street Journal profiled trader, Captain Condor. I'm going to pull up the article from earlier this year.
It's a funny story. I named I provided the nomiker Captain Condor, and we figured out who the guy is because he made a snowboard of Captain Condor. So he sort of doxed himself a little bit there. I provided an unbelievable amount of information.
David
I came
Chow,
to Wall Street
right?
Journal
Yeah.
with this story, and I got like one quote at the end. I was like, man, come on.
Come on, Crystal Her.
Hours
Gotta
of work on that thing.
give
man.
the
So
source
anyways, I know this intimately. I also feel like he should have sent me a fruit basket because I had to think that this was pretty good for his business, being on the cover of Wall
Okay,
Street
because he's got a big, what is it, a Discord or his trading
He's got a
community?
Discord, and he sells this strategy, which is putting on these Condor trades. So that's important to this story because he is apparently a fairly large trader. It's not clear how much of his Discord channel follows him or if he has some wealthy people that tag along with him. So I refer to Captain Condor, and I'm referring to sort of this person, but he represents this
The
Discord
style of
channel
trade. Yeah.
Right. So why does this matter? He runs a martingale strategy. You're a betting man, so you're familiar with that.
Yeah, a little roulette.
Yeah, you sell some condors, and if you're wrong, you double down the next day. So as
Double
the famous
down.
saying goes, don't frown, double down.
Yeah.
So
Always
my
double down,
argument
Mikey.
with this was with the Wall Street Journal was that at some point a few different things happen, right? You run out of capital, you can't keep doubling down, or just like the casino will come out and say, Oliver, please stop doubling down now, you're done. And so even if you have the capital to continue, the bank,
wish.
i.e. the casino, i.e. your clearing provider, your broker just says, no, you're out. Those are all risks to the martingale strategy. So Captain Condor here starts off with generally 5,000 lot spread, and he was wrong. So it was 10,000, then it was 20-something thousand. Today is 40,000 spreads, and the spread position, and Oliver, if you bring up Trace, you can see this position very clearly.
Okay. Yep. Let me do it.
This position is at 6,900, 6,905. And so if the market closes over that, the S&P closes over that, it appears that Captain Condor and his band of flock,
Of
I don't know what
merry,
you call that.
his band of merry martingalers.
His band of merry martingalers.
What am I looking at here for Trace? How should we show this?
That's it. So just zoom in a little bit, and Oliver, you can see there's a huge position there, right? And it looks like a little part of that may be close. So on the right side, you can zoom in. Just drag that guy over there.
Got it.
There you go.
Oh, yeah,
so
yeah,
there's
got
two
it.
big
Nice,
bars
nice.
there.
Oh, perfect, yeah.
That's the condor spread. It looks like part of that was maybe closed. You can see the blue bar is not taking up that full candle, right? So it looks like maybe some of it was closed, but this was the position. And so the view is that if he's wrong today, he may have to double down tomorrow, which would be going from 40-something thousand to possibly like 90,000. And that's on a shortened holiday Christmas Eve day, which is pretty fascinating. And the other interesting part of this is that, you know, the capital at risk here starts to get pretty big when you start doubling. It's the law of convexity, I think you could call it.
Sure.
So yesterday, if you lose on 23,000 spreads, I'm guessing that they sell these condors for about $2, which means they have about $3 of risk. And so at 23,000, they lost about $7 million. At 47,000, if they lose today, that's about $14 million. And if they have to double down tomorrow with 90,000 spreads, that's another about $28 million. So you're talking about $50 million of risk, which, you know, that's not enough to blow up the S&P 500 or anything, but as an individual trade or group of traders.
Oh, yeah.
And again, I'm doing a ton of speculating here, so I don't know specifically what this guy has on or what his friends have on. This is all for entertainment value only.
Well, I think it's relevant because I know personally several other people who don't necessarily use the strategy per se, but the idea of the homegrown hedge funder and the pro-tailor trader is really what this show is all about. And so I know a lot of people are, you know, in that camp that watch this. And by the way, that was kind of my story of the day. I honestly forgot about it. I was having so much fun talking with you guys and the guests this afternoon. But Citadel's numbers came out, and they were only up 9% this year. It's the worst year for Citadel since 2018. Okay. Meanwhile, the charts of Robinhood and exchanges and brokers are exploding. So this idea that it's been a good year for the individual kind of investor, the pro-tail investor, I think is the story of the year, frankly. And it really began with the everyday person buying and getting long during the tariff hysteria when a lot of institutions kind of fell into a little bit of what I would call a political trap, thinking that that was what was going to drive markets and that was going to be kind of a permanent thing. So that's just kind of a side point. So, you know, maybe even if you're not using the strategy that this Captain Condor is, I think to think about how kind of the everyday person has accumulated big size, and now what they're doing with it is very, very important.
And 50,000 out of spreads, which is roughly what they have on today, is huge. People talk so much about the J.P. Morgan collar trade, which is 30 or 40,000 lot position. So, you know, if you're talking about 50,000 contracts are on right now, and they got to double that tomorrow to be 100,000 roughly, 90 to 100,000, that's huge. And I don't ever want people to lose money trading. Like, that's not a great thing, and I don't want to seem like I'm celebrating this. From a voyeuristic perspective, this is
it's an interesting story.
But we've sort of been admonished a little bit because we're saying, look, statistically, this is going to break down at some point. You have to just be wrong a certain number of times before this breaks. And kind of like in the days of saying, hey, GameStop people, you should probably take a break on GameStop, or the AMC apes who just said that this thing is going to go to the moon at some point. By the way, I think all-time low for that stock somewhere, it's like $1.19 now. Yep. People don't want to listen to those stories a little bit where you go, this is very dangerous, and even though it makes money, this is a positively skewed strategy, at some point it can go very, very bad and you lose everything. So you go
bankroll
from picking
management.
up pennies, then the steamroller hits you and you break. So, you
right.
know, it's going to be fascinating to watch for tomorrow. It's
a really important message on bankroll management regardless what you're doing. Because even if you say, a lot of times people talk about the roulette example of martingale strategy, and of course, you're already behind there because it's not a real 50%. But let's just say, and you're probably, you know, behind, I don't know, let's say the market you can get a pure 50% just for argument's sake. The concept of variance is how successful poker players blow up. It's how successful traders blow up. Is even if you have a 50% strategy and you're doing this martingale, which counts on that 50 holding, if you're not using your bankroll, if you're not, you know, if you don't have the bankroll for it, you can blow up with variance.
Right.
So, it's just risky when you're increasingly put on more size for any trade. Does it?
And the other
it
thing
also. Yeah, go ahead, Brent.
I didn't mean to interrupt you there, Oliver. I apologize.
Yeah.
The other thing is he's doubling down the next day regardless. So he'll double down even though it's FOMC the next day. And apparently they also don't look at vol. So there's no optionality.
How do you not look at vol if you're
process.
putting on Yeah.
I think it's technical analysis that's used to start the position. So
Interesting.
you're selling options and this ties into the whole argument of just systematic call selling being a problem anyways. And it's shown that your total returns aren't as good in call selling strategies, particularly systematic ones. Look, there are times to sell options, like if vol premium is healthy, then go ahead, sell options. It makes a ton of sense. Putting a gun to my head and saying you're selling options every day for the rest of your life, that doesn't sound like a great strategy, which, this maybe falls into that category.
Yeah, very fair. All right, I think it's a good analysis, even to your point, even if it's somewhat voyeuristic. I mean, hey, we gotta have some entertainment value here. The last point, Brent, is thinking about the broad market. If we do hold here, given how many kind of half days and holiday days we've got, what's the simplest sort of trade then you think going into next year?
I'm going to tie this back to Captain Condor again, because there's this strategy called seek and destroy where these big positions come into the market and it's like the market has to touch those levels. So right now the position at 6,900, 6,905, coincidentally the market kind of pulls up into that strike today. If they roll up and sell 69.50 area calls for tomorrow, I think that's probably going to be where the market goes and touches tomorrow. So I'm going to watch where that position rolls. But also tomorrow, the half day, market likely just grinds higher. Same thing with Friday. So again, I could easily see another 0.5%, 6,900 to 6,950, I think. And then next week, I don't really have a very strong feeling. I mean, the JP Morgan collars position rolls, but the idea of that bullish OpExmas window helping us out, that goes away, and then you got to kind of sort of reassess things. If you look at downside from here, I'll just say this, and I know we got to move on here. Negative gamma exists down to the downside here, meaning that if we start to sell off after this week, there's nothing to really stop us, right? There's dealer hedging flows could push the market lower, but now we have vols at least 1 year lows, right? So there's a lot of room for vols to spike suddenly, right? And even just a correction. It doesn't have to be a bear market in perpetuity. Yeah. So there's a lot of things aligning now that could lead to a nice correction to start the next, end of this, last week of this year, start of next year, that I think people should just be aware of. So again, the OpExmas rally here is happening, and then I think we're going to be a little bit cautious into New Year's and then starting in Jan.
I think I'm going to keep going with the general strategy that I've had, but maybe lean into the longer vol side of it rather than the long stock side of it, since some of that has been realized. So combining your and Noel's analysis, he had that 10-to-1 volatility spread, so maybe you do that in addition to being long the stuff that's been working with momentum. Merry Christmas, happy holidays. Thank you very much, Kimosabe, Brent Kochuba.
Thanks so much, Oliver. Have a good Christmas.
You too, man. Brent Kochuba, Spot Gamma. 2-minute buffer break, and then the Mr. Charles Moon is bringing it home for us into the bell for Prosper Trading next.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
showing a pretty lagging year for Citadel is one of the main stories of the year, up 9%. I think it tells a story about the pro-tail everyday investor who has been able to conquer this market in 2025. The stock of the year, as I've talked about many times, is Robin Hood. Here it is, up 200%. Why not check out BATS as an example as well, up over 200%. Now, Mr. Charlie Moon joins me as we think about closing out this year, and as we think about also the fact that I think it's been a pretty good year for the individual trader, the pro-tail trader, if you will. Mr. Charles Moon joining us from Prosper Trading Academy. What's up, Charlie?
What's up, Oliver? How's it going?
What do you think? Is that the story of the year, the individual investor who bought the tariff dip in the spring, who was, as long as, now crypto might be a different story, but if you've been long equities, if you've been long stocks, it's been a pretty great year.
Yeah, 100%. I actually think that you're pretty spot on about the retail trader. They're getting smarter. They're more well-informed. And, certainly COVID has brought all this on. But, I don't think it's actually just the rebound from the tariff drop. I think it's the actual drop itself where they were benefiting greatly because that drop hurt Citadel. Citadel reported a negative quarterly return. And I had plenty of people in my room that were absolutely destroying it to the downside. So I just think it's that traders are getting a little bit more comfortable trading in both directions. And we're now seeing that the retail traders is getting far more aggressive because they're not trying to get involved with equities. They're actually trading with options a lot more and utilizing that leverage.
That's a very good point. Of course, that's a big theme of the show and what we're doing here, and being able to use options to hedge at the same time as speculate, being able to kind of learn how to surf in waves that are generally dominated by the giants of Citadel and the market makers. And it's kind of a nice situation where you could maybe have everyone win together to some extent. Maybe I'm wishful thinking, but I think that if you don't complicate it and you kind of trust that technology generally is supportive and drives capital markets, then participation in that market is a good way to hedge against technological disruption. That's been another big theme too.
Yeah, 1,000,000%. And, you just spent some time talking about martingaling. This is something that I've learned about from a blackjack standpoint. Usually you only martingale when you start losing. Theoretically, that's kind of how traders have traded, that some traders have bought their way out of losing trades. Some traders will compound their winners. And I think that's where we're seeing the skill set of the retail traders grow vastly in relation to the market movement and volatility. You look at Citadel, they're Citadel, Renaissance Technology, and others, their entire edge isn't really always attributed to math. Certainly they got the quants, the quantitatives, as they say, on their books. But truth of the matter is that their edge has always been about latency. It's about getting in and out before anybody else can and swiping at that liquidity that they can utilize to take advantage of. So, I just think that the retail traders now being more well-informed, being more shorter term versus longer term, more willing to short the markets and more willing to take an aggressive stance. Martingaling it the entire way, it's kind of led to that, really jump in Robinhood and ICE and other exchanges because, when they start telling their friends what they're doing, how much they're making, all of a sudden others start getting intrigued. And you know how it spreads.
Well, I like the idea of being passively long the market and using options to apply leverage in both directions. I think that's really the beauty in between, because the edge and the whole boom of ETFs has been to allow people to participate without trying to pick the individual stocks, which is obviously very tricky. But when you have that kind of base position of being long the market and then can use options to speculate and to put on conviction trades, because to your point, the way you make money in anything is with conviction. Scared money don't make money no matter what really you're in. Though perhaps the passive market could argue that scared money can make like 7% a year. What are your trades of the year, Charlie? And do they live until next year? My trade of the year was long stock, short master. Nothing changes there, but it might be a little bit tougher for next year. What are you into?
Right now, a good portion of the year, quite honestly, it was all the data center plays, but it was the growth names. It was IREN, it was Cipher. Cipher, got on my radar when JP Morgan gave them coverage at $6. For me, this was a penny stock that was tied to the crypto industry. I was wondering why all of a sudden JP Morgan wanted to give coverage when they would never, ever try, look into that sector. And sure enough, Cipher exploded and certainly is still trying to move higher. Hut is another one in that sense. Right now, for me, it's the memory segment. We're looking at the best performers out of the AI sector, the ones that have been able to maintain through this volatility, and names like Micron, which today is still making new all-time highs. SanDisk started screaming off the lows. So I still believe that segment could be a powerhouse going into 2026. If the AI growth story still remains a play here. So, you're correct. And quite honestly, it's almost the smartest way to approach it. Why not have your money parking in ETFs, which generally was averaging 3 to 5% returns, that are now doing 8 to 12% returns? It's a vastly different market than what we have traded just 5 years ago. And that was a vastly different market than what we traded 10 years ago. And so this is now just seeing that things are moving on a bigger scale, more volatility, more participation, and this is all just equated to opportunity to make money. If you're smart with your money, just like what you said, it's a great approach. Park it in something that's tried and true and slow and steady, and take your shots with the martingale options.
STX, Seagate I just had up, also a huge year in addition to Micron. I guess I didn't realize that that Seagate was up. I remember when it was kind of going nuts and really picking up momentum in the summer, but just that it's participating as well. I think this speaks to the notion that the AI trade is, at least in a middle stage, is not really in a late one, as we are seeing now legacy companies. Remember, nobody wanted to touch Seagate a couple years ago. People remember how cheap Micron was relative to the rest of the group. It was laughable. So now that you've had these monstrous moves, I think it shows the power of what this technology is doing to awaken sleeping giants to some extent.
I mean, it's a $300 stock now. Who would have imagined this at the beginning
Seagate,
of the year?
$282.
Yeah. So I actually am going to disagree with you. I don't even think we're in the middle portion of the AI stage. I still believe we're in the infancy. We haven't really seen the true benefits of what AI can bring. If you actually look into a similar documentary on DeepMind through Google, this is where AI is going to eventually come. But DeepMind is already at a point where there's machine learning, and they're utilizing this machine learning to benefit mankind. So this is where I see the segment in the infancy stage, and then out of nowhere, there's going to be this big leap when we get to that midpoint. Now, I don't know what that's going to do for valuations. There's certainly going to be names that are going to stand down. There's going to be names that are going to come crashing down to earth. And for me, when we look at a segment of growth, I'm always going to look towards where the biggest money, the best performers, and the strongest names are, even in this infancy stage. So my money's still parking towards Amazon, towards NVIDIA, towards Google, towards Microsoft, towards Meta, because they're the ones that can withstand any downturn. They're not really worried about CapEx. They're not worried about having to raise money to stay, afloat. These are going to be the true leaders, because if they don't develop the technology, they're just going to die.
Yeah. By the way, good point on the Mag 7. Other than Alphabet, it's been pretty quiet in that cohort for a couple months. A lot of chop. So that might be the simple Occam's razor. What to start off with next year is the reawakening and momentum now that those have spent enough time clearing out, right? There's two ways to normalize your valuation in a stock. You can either go down in price quickly, or you can go sideways slowly. And so the earnings certainly have not dissipated in those giants. So a lot of those charts that might be sideways might be ready to move again, especially when I think about a Meta per se. Charlie, I do want to get your last closing thought here on the crypto stuff. I have to be honest, I'm actually at this point starting to get a little bit surprised by just how bad Master is and just how weak Bitcoin is, because I thought that trade maybe had sort of run its course, but I don't know. Looking at the master chart, maybe not. Give me 60 seconds on crypto, sir, please.
Well, like I said, they lose those lows. They just reignite those sellers to just jump right back in and to fade them down. It's almost as if they're the whipping boy of the sector right now. For me, BTC, they're getting stonewalled at 90. They broke above it the other day, but failed to hold. So the moment that they could actually get above and hold that level, that's when they push for 95, 98, knocking on the door of 100,000. I do believe that once the new year starts, new year, new me, we could see really a lot of demand for BTC and just crypto really start to amp up. But for now, they're just running into this brick wall at 90. We'll see what happens there.
New year, new meme.
Yeah, right.
Great stuff, Charlie. Thanks a lot. Great way to bring it home, as always, with the Prosper team. Mr. Charles Moon. I'm Oliver Rennick. Thank you.